Hi everyone, welcome back. And today we are going to start in this new lecture with a new chapter, that is mutual fund. This is going to be your last chapter for the volume 1, and this is going to be asked for 8 marks in your exam. So what I am expecting in the mutual fund chapter is 8 marks of practical question max to max, or 8 marks of practical question plus 4 marks of theory. So 12 marks max to max, 8 marks minimum. That is how much this chapter will be worth for. So but although the marks are less in terms of rest of the chapter, but the chapter is also small, plus the advantage is it is very easy to solve mutual fund questions, rather than going for portfolio and security valuation. They can trick you in the security valuation and the portfolio chapter, but it is not that difficult, not that easy uh, to trick you in the mutual fund. So mutual fund questions, you will feel that mutual fund questions are pretty easier than the rest of the chapter. So make sure that this is your strong chapter. The small chapters are should be your strength, so that it gives you a boost in the marks. So that is the first part that we discussed. Second thing is the number of question that we are going to solve. So in volume 1, the last chapter is mutual fund, and you can clearly see that there are only 40 questions. When you compare the security valuation and the portfolio management chapter, the number of questions were a lot. Like they were huge in numbers, 131 and 95. So we have already solved more than 200 questions in those two chapters itself. But mutual fund chapters have 40 questions, and even in that 40 question there will be a repetitive question. So I am expecting around 32 questions only of a single type. So that's better, that's good for us, right? So in the coming 5 lectures, most probably we will finish this chapter. Before coming over to the exam point of view, let's first discuss why we need to invest in the mutual fund. And as a student of a CA final, if you have not started investing in the mutual fund, then let me tell you one thing: you are already late in doing that. I know after becoming a chartered accountant, and when you will be going into the market, discussing with the people, you will start investing in the mutual fund, and that will be again too late. So, the very first thing that I'm asking you is, after you finish this chapter, just go and start investing in the mutual fund. And the mutual fund investment doesn't need a lot of money. See, only 500 rupees is the minimum that you should invest every month. The most important thing right now is to not earn a good return, but to get habitual for investing in the mutual fund. So that's maximum of 6,000 rupees a year for the next 1 year. Then you can increase that money to like from 500 to 1,000 a year, 1,000 a month. If you can put a lot of money like 5,000 rupees a month from now onwards, if you are earning that much, then it's well and good. But at least 500 rupees, I think everyone can afford. If you have afforded investing in the SFM lectures and the rest of the lectures for this much of the amount, 500 rupees of investment in the mutual fund will not be a big deal for you, right? Now, the question is, sir, why you are suggesting us to invest in the mutual fund? Let me tell you one thing. Most of the people in India knows only four different kinds of categories for investment when it comes to saving money or increasing money. Everyone needs to increase the money, like everyone wants to increase the money. First thing, everyone is waking up every day and going to a work, like 9 to 9 work, a job, or teaching, doctor, engineers. There are lots of professionals, sportsmen. Everyone wants to earn money. One thing, see, a lot of people are doing it, earning money every month because they have to. It's like their responsibilities are so much that they need to earn money. Second thing is, a lot of people are doing it because of the passion, because they love their work, and that's why they earn a lot more than the one who is not loving their work. Okay, but all in all, the common goal, we can say, of the 99.5% of the population is to earn a lot of money. First thing, if you want to increase your wealth, whether you want to increase it by working your entire life, or you just want to work for some years, 5 to 10 years, and then enjoy a financial freedom in your life. Now, what is financial freedom, sir? Financial freedom is something where you can earn money and still getting a free time to spend with your family, friends, for your passion, like playing cricket, basketball, anything. You might not be earning by doing those activities, but you have set yourself into such a system or a passive income that you are earning every month. See, this is what should be the target of every person. Right now, I am sitting in front of you, but do you think I will be teaching SFM for the entire life? No, sir, not at all. I don't want to do that. I don't want to affect my health, put an impact on my health just because I want to teach you or just because I want to earn money. No. So for some years, I'm going to do that. I'm going to collect that money. I have already been doing it. I'm collecting the money. I'm putting that money in my investment package. I'm not enjoying that money, okay? I'm not putting that money for a luxurious thing or spending too much on the weekends, parties, and all that. Entire money is going into investment, okay? A different kind of investment. I will talk about it later. And one of those investment where I'm putting money is the mutual fund, okay? And I think the second most, second or the third most valued or highest investment that I have made in a particular investment, a particular category is the mutual fund itself. Okay. Now, it's very important to get or to achieve a financial freedom in life. Financial freedom means you don't have to work but still earning. You are not working but still earning money. That's called as a passive income. Mutual funds will not give you immediate returns, but if you keep it for the next 10 years, then you will see the magic happening at that time. So 10 years, you can say a minimum requirement is there. So that's why I'm telling you in the beginning itself, if you have not started it, just start it, so that that 10 years countdown begins from now itself. If you wait till you become a chartered accountant and then you start earning like after a couple of years, so if you wait for the next 2 3 years and then you are thinking of starting investing in the mutual fund, then you will already be late. You will be late by around 3 years itself, right? So 10 years countdown will begin after 3 years, and I don't think so you should do that, because in those 3 years period, approximately I can say you will be losing around 40 50 lakhs rupees if you take a long term view. Okay, that's my job to inform you. That was my job to inform you that you should start investing in the mutual fund. Let's come down to why only mutual fund. So I just told you while discussing that there are four different categories where most of the people in India thinks of investing. The first category is savings account, and I think that's the worst category. They keep their money in the bank account. I don't know why. 4% of the return you earn in the saving bank account. The risk in the saving bank account is very low, almost nothing, but the returns are also very low. And most of the amount you keep in the saving bank account loses its value. Why it loses its value? Because the inflation in the past 4 5 years, like past few years, is itself 4 to 5%. So your money is losing value by 5% and you are earning only 4%. So practically speaking, 1% still you are losing on your money if you keep that account, if you keep that amount in the saving banks account. The second option that people choose for is to invest in the fixed deposit. Fixed deposit can give you a little higher return because of one major difference. In saving bank account, you can withdraw your money anytime you want, you can put money anytime you want. But in fixed deposit, what happens is for a minimum period, for a lock-in period, that money gets locked and you cannot take that money out. So for that purpose, what happens is bank thinks that okay, we have this money for around 7 years, for 3 years, for 2 years, we can use it for wherever we want. And because of the freedom that the banks has received from you, banks will give you a little higher percentage, so 4 to 7%. Risk is still low. We can say return will always be low. So 7% is still, I think, low return itself. Now, the third option that people think of investing is the gold. I think gold in recent years has not given us so much of the return. But yeah, in the last decade, in like we can say 2000 up to 2010 and up to 2015, it has given a good returns. But after 2015, I don't think so. It has given so much of the returns which attracts people to invest in the gold. So but a lot of people invest in the gold because their parents and the society tells them that this is a good option to investment, whereas it is not at present. Fourth option, where most of the money goes, is the real estate. You might have heard about it in villages more, like people gather money and then they start buying lands and lot of properties. So this is a good option for investment. But there is one problem with the real estate. The one problem that is with the real estate is the it requires huge capital, and that's not the that's not a cup like any everyone's cup of tea. You need at least a crore or something rupees to invest in the real estate if you want to buy a land in a city or like suburban areas. So that's not even possible for a student like us. So what happens is, another option people think of is the direct investing in the stocks, and that is very risky, highly risky, but it gives you high returns as well. So you might lose your principal value as well, but the returns are very good in stocks. But my suggestion to you is you should only invest in the stocks only if you have a proper knowledge. You can do the research, you know what is P ratio, you know lots of factors about the market. The good part is, since you are in CA final, you have learned about portfolio and the stocks in the portfolio management chapter as well. So in SFM you will learn a lot about time value of money also. You will have a good knowledge after becoming a chartered accountant, but most of the people in India doesn't have a good knowledge about all these basics, and that's why they are not eligible to invest in the stocks. Not eligible means they are eligible, but practically they should not be investing investing in the stocks directly, because they don't have a proper knowledge. Because what will happen is, because of this they will lose money, and the losing principal amount is will hurt them. Finally we come to the mutual fund. So what is the option, sir? See, I will tell you. Mutual funds will serve the purpose of investing in the stocks, investing in the real estate, investing in the gold as well. So there are many mutual funds available in the market which takes the money from you. Please understand the structure, which takes the money from you and then they invest in the gold, real estate, stocks, etc., bonds, and many other instruments. So mutual fund is basically an intermediary set between you and the direct instruments. So they take money from you and they put well qualified people, professionals, and who can give their 100%, and they take the money from you, these mutual funds, and then through those professionals with a highly qualified people in their team, they invest in the market, they invest in the gold at the right time, right price, in the real estate, in the stocks, and their ultimate purpose is to increase the value of your investment. So basically it's kind of what you can imagine is, you have hired a person, a qualified person to invest in the market, just like you hire a person to do some course of your home, or we can say your father has hired a person who can file their income tax return, or a CA of every client. Why do they hire? Because that person is a professional and they can take care of the compliances and all that thing. And in the similar way, for taking care of your investment, you need to hire good people. So that's the mutual fund is going to do for you. Obviously they are going to take their share from the returns that you will be earning. So if you would have invested directly in the stocks, in the similar stocks, and you would have earned around 20%, then I think mutual fund will give you only 15%, 16%. They are not going to give you 20%, because they are going to take their share also, na? They are not working for free, they will not be. So they will take their share, but still, without giving time, if I'm earning 15-16%, then I will surely go with the mutual fund rather than going directly to the stocks and giving 100% of the time for investing in the stocks. Getting it? So even if I don't have the knowledge, I can go to the mutual funds. Obviously mutual fund requires some kind of a knowledge, but not that deep as the stocks requires. Getting it? So mutual fund is basically a company, an intermediary set up in between you, investor, and the direct instrument. What happens in the mutual fund is, they take money from you and they give you in units. They don't give you shares, because all the mutual funds are not investing in shares. Mutual funds can invest in the real estate also, they can invest in the stocks, they can invest in the golds as well. So what all the mutual fund will give you is units. It's just kind of a share in the stocks. So you will be giving money to the mutual fund, they will be giving units to you. This is called as units. And the money that you will be giving to the mutual fund or investing in the mutual fund will be at a price called as net asset value, and for that NAV you will be getting some units. It's just like market price in equity share and number of shares in equity. So we get a share when we invest in a company at a market price. In the similar way, we get units of that mutual funds when we invest at net asset value. Okay, we'll talk about it later. So after taking money from you, the mutual fund does all the research, and whatever category you have selected, they will put your money in that category itself. So while investing 10,000 rupees, just imagine, while investing 10,000 rupees in the mutual fund, if you have specified that you are investing in the stocks, then they will put your money entirely in the stocks itself. If you tell them that you want to invest that money in the real estate, then they are going to invest your money in the real estate investment trust, REIT. Okay, if you tell them that this money should be invested in the gold, then they will be investing in the gold mutual fund. So there are many mutual funds available in the market of a different category according to different needs of the people. So wherever you want to invest, you just select that kind of a mutual fund. I will just show you in a moment, and then your money will go into that direction only. That's a very good thing which is happening right now. So you can put money here, you can start investing 500 rupees a month, and you can set a systematic investment plan itself, which is called a SIP, where automatically 500 or 1,000, whatever you suggest, money will get deducted from your bank account, will get invested in the same mutual fund that you have instructed to them. Okay, so this is how everything works. Getting it? The reason why the mutual fund is there. Now most of the time we will be learning about the NAV, net asset value, calculation of this NAV and the returns which this person is earning, the investor is earning. What happens is, in return, how this person, this investor will get returns is that the increase in the net asset value. So if he is investing at 10 rupees NAV today, and tomorrow if the NAV goes to, let's say this is NAV 0, and tomorrow if the NAV goes to NAV 1 goes to 11 rupees, I can clearly say that in a year 10 rupees of the NAV has gone to 11 rupees. So that's around 10% of the return. 1 divided by 10, 11 minus 1, 11 minus 10 divided by the initial NAV. So that's around 10% of the return. So, but that's not just the only return that investors will be getting. Mutual funds sometimes declare dividend as well. So they distribute dividend and capital gain as well. So your return includes, in the mutual fund, your return includes three things: capital appreciation, which was the difference between NAV 0 and NAV 1, capital gain, and dividend. See, what used to happen in the equity share. This is directly equity share, the portfolio management chapter that we discussed about, and this is mutual fund. Okay. Here you buy shares. Here you buy units. You buy it at a market price, you buy it at a net asset value. Okay. Then in terms of return, it was dividend plus capital appreciation divided by initial investment, that is the market price. I can easily write down the market price here. But in what happens in the mutual fund, the returns are calculated as the difference between NAV 1 minus NAV 0, that is the capital appreciation, and apart from that, if any dividend has been distributed by the mutual fund in that year, and the capital gain if they have distributed by the mutual fund, divided by NAV 0, means the basic initial investment. So initial investment will be in the denominator and the total returns will be in the numerator. So there are only two returns here: dividend plus capital appreciation. Second, in this case there will be dividend plus capital gain plus capital appreciation. So these two parts are same, capital appreciation. So this capital appreciation also you can write down like this, market price 1 minus market price 0, and this is market price 0. Am I right? This is nothing but the capital appreciation. So dividend plus capital appreciation divided by MP0. The formulas are same because the concept is same. It is all about returns. So returns will be in the numerator, whatever types it is, and the investment will be in the denominator. Okay. Now the question comes is how to calculate the net asset value. Net asset value itself means the total of the assets minus liabilities. Now net asset value is calculated as on every day. Okay. Net asset value is calculated every day as total assets minus total liability. The good part that you need to understand is for all the assets and liabilities, it should be at market value, not the book value. It should be market value or realizable value, at which price it is going to be settled. If you tomorrow if you go and settle the assets, it will be sold at the market value. So market value of the total asset is important to calculate net asset value. If you have to settle the liabilities, the book value will not help. The market value of the liability is to be considered. So total assets minus total liabilities will give you net assets. This is going to give you net assets, and net asset value is equal to total assets minus total liabilities divided by number of units. Am I right? This is the value, net asset value per unit. So if we want to calculate per unit, we have to divide it by number of unit. In the similar way, if we have to calculate the market price per share, what we used to do is market value divided by number of shares, right? Market value divided by number of share will give you market price. In the similar way, NAV is nothing but the market value of the assets and liabilities. So that's net assets divided by total number of units. In the similar way, total number of shares is taken in the denominator. We will take the total number of units in the denominator to find out NAV. So NAV is calculated as very simple: total assets minus total liabilities divided by number of units. So we will be solving some questions. So this is going to be one formula for you. Second formula is holding period return. Holding period means for the period that you have held the mutual fund units. So if you have started on 1st of the January and you have sold those units till 31st of the March, the holding period return will be calculated for these 3 months. So whatever return it gives, like let's say 10%. If you say holding period return is 10%, then 10% is not per annum. It is for 3 months. Because the name itself suggests holding period. For the period only we held these units, the return is calculated. And you can calculate, then you can convert this into per annum as 40% per annum. You can do that as well, 40% per annum. Good enough. So these are the two formulas that will be used most of the time. Apart from that also there are number of formulas, but we are going to take that after certain question. So let me just go through the portfolio that I have constructed, not on this. Just a second. I will just show you the reality. Enough of the talking and all. Let me just start. Yeah. See, if you can see here, I will just scroll down. You will see this is the current value of my mutual fund. 44,07,920. I invested around 30,80,000 till now in the mutual fund. The returns are around 14 lakhs. You can see clearly the gains here are 13,30,000. After investing 30 lakh rupees, I have a gain of 13 lakhs. The absolute returns, if you want to calculate, is 43.20%. And if you go for the annualized return, it is 14.61%. Simple annualized return. 14.61. Simple annualized return. 14.61. Yeah. 14.61 into 3, that's 43.83. Almost for on, or you can say that my average period of investment is 3 years, average period. So I started like 4, 5, 6 years back. When I started, I was also late. I started after becoming a chartered accountant because there was no one to guide me to start the mutual fund while I was a student. So that's what I want, that you should not make that mistake. So I started after becoming a chartered accountant, immediately after becoming a chartered accountant, and I was like investing only around 500 a month for a year or two, then 1500 or 1000 rupees a month for a year or two. So for the first 4 years, 5 years, you can say the investment was not more than a lakh rupees or 60, 70,000 rupees for the first 4, 5 years. But then in the last 4, 5 years, from 1 lakh to 30 lakhs, it has gone. And I'm investing around 43,000 rupees a month. You can see clearly here. I will just show you. Yeah. So this is the total systematic SIP that I have started. 15 SIPs are there. 15 SIPs are there. So every month, through 15 types of investment in different 15 mutual funds, the amount is going around 43,000 rupees only. I am investing in every month in the mutual fund. As of now, I have reduced it. Like last year, it was good amount. Around 1 lakh rupees I was investing, but I had to take the money out. Like I needed money for some other purposes, and that was the real estate itself, and that's why I reduced my systematic investment plans here. So it came down to 43,000. So in the last, if you take that average years that I have invested for that 30 lakh rupees, 14.61 is not a bad return. It's a very good return. And see, you can clearly see the categories that I have invested in. Most of my money has gone to equity. 93% of the total investment I have done in the equity types of mutual fund, not directly into the equity types of mutual funds. Okay. Let's go to the subcategories. Subcategory means these are the categories or the types of mutual funds. See, aggressive mutual fund means it is very risky to invest in that, and they invest in these type of mutual fund invest in such type of companies or the stocks where returns can be very very high. Okay, but the risk is also very high. So you can see that 3 lakh rupees invested in this, there is a profit of 1 lakh rupees around in that. And equity linked savings scheme, flexi cap, focused funds, large and mid cap funds. What is large and mid cap? Large companies like Reliance, TCS, these are called as large companies. Mid cap means a mid size company. There are three categories: large cap, mid cap, and small cap. So very small companies are called as small cap companies whose value is small. So all the companies are normally divided in three categories in the share market: large cap, mid cap, and small cap. Okay. This is small cap. Getting it? Small cap. Okay, let's go to the asset management companies. So in what type of companies I have invested? So if you can see here, Aditya Birla Sun Life Mutual Fund, and there are various types of mutual funds in the Aditya Birla also, in the Franklin also, in the ICICI also. This is just a asset management company. So if you go through it, you can see that most of the investment I have made in the Canara Robeco mutual fund, and the second highest is in Franklin Templeton. That is around 7,80,000, the current value I am talking about. Then ICICI mutual fund around 6 lakh rupees in that. Then SBI mutual fund. So you can see ICICI, IDFC, Kotak, SBI, Tatas. All these are the categories of the mutual funds that I have invested in. Again, if we want to go directly, so when you saw that Canara Robeco, that was just an asset management company. But here you will see this is Canara Robeco Blue Chip Equity Fund. This is Canara Robeco Emerging Activities, Equities, and yeah, there are only two. Then Tata Large Mid Cap If you go into SBI, this is SBI Technology, SBI Blue Chip. So there are multiple types of mutual funds in the same company itself. We can select it through this particular section. If I go to invest here, let's have a look, and if I choose ICICI, just a second. See, all ICICI Prudential Mutual Fund Scheme. So then I will go to category. So there are multiple categories in ICICI Prudential Mutual Fund schemes where you can select hybrid, others, and only equity. Hybrid means they invest in the equity shares also and the bonds and the safe investment as well. So you will be able to see multiple types of ICICI mutual funds. You can clearly see there are huge number of lists in the ICICI mutual fund itself. They have more than, or I think, 1200 mutual funds. Right now, 426 in my Sharekhan trading account, but I think around 1200 plus funds are under the ICICI brand. And see, the minimum amount that is required for investment is given in the second column. You can see 100 rupees is only required to invest in the ICICI Prudential Debt Management Fund. 100 rupees here, 1,000, so you can even start with 99 rupees of the fund every month, and that's a very small amount. Okay, see, I will just go through the highest return category. Yeah, see, the first thing, ICICI Prudential Technology Fund, the last 5-year returns are 26.85% per annum. This is 17.04% per annum. That's a good return, right? You can start investing in this manner. Okay, if we go through a particular fund, returns are not the only thing that we should be looking why before investing in the fund. What are the expenses of the mutual fund also matters. Expenses, the fund manager, lots of thing matters. So we will get all the details in such type of a page. So whichever platform you choose now, you go through the fund details where you will get to know a lot about that particular fund. See, the current NAV of this ICICI Prudential Technology Fund is 133.92 rupees. So with this amount, you will get 1 unit of this mutual fund. Then comes the type. There are 2 types of mutual fund, open-ended and close-ended. Open-ended mutual funds are a category. There can be a question of 4 marks in your exam. Differentiate between open-ended and close-ended mutual fund. You will get that detail in the theory book. So open-ended mutual funds are a type of a mutual fund where you can invest anytime you want throughout the year, and you can take back your money through any time you want. But a close-ended mutual funds are such type of a mutual fund which has a set period in which itself you can only invest. So if the dates are specified like 5th August to 15th August, you can only invest in that time frame, and you can take out that money only through a particular time frame itself, means at the end of the month or at the end of the year itself. It is not open to do the activities anytime. So that's why this one is called as open ended, because you can invest anytime, you can divest anytime. And close ended means it has restrictions. Category means this fund, if you put your money in this fund, your money will go into equity share. So these people who are investing, who are taking money from you, will invest your money in the equity shares. The NAV date that they have calculated is 133. NAV of 133.92 was of the 29th July 2022. So I think that is 2 days back. Okay. So this is the funds overview. The objective is to generate a long-term capital appreciation by investing in equity and equity-related securities of technology-intensive companies. So the name itself suggests ICICI Prudential Technology Fund growth. The growth means capital appreciation. So their main objective is that the NAV should grow first. Second thing is they will be investing only in the technology type of funds like TCS, Infosys, Wipro. These are IT related companies. Technology related companies will be chosen for this mutual fund. Okay, then this fund was launched on 3rd of the March 2000 itself. The net assets right now with the company is 8,500 crore. The lowest NAV that has gone on 17th June 2022, that was my birthday, 123.91. Okay, benchmark name, exit info. See, if you invest today and if you take out your money within a year, most of the mutual fund will charge you exit load. Exit load, entry load are the charges that you need to pay. That's all an expense that you need to pay to get into the mutual fund and get out of the mutual fund. So most of the mutual fund are not charging anything for getting into the mutual fund. But if you take out the money, if you sell all the units and you want to take out the money, they will charge exit load. So there are some information related to exit load. If units purchased in from another scheme of the fund are redeemed within 15 days from the date of allotment, if you redeem it within 15 days, then 1% of the applicable NAV will be your exit load. So you will have to pay 1% as exit load charges if you redeem that amount within 15 days. But if you redeem it after 15 days, then the charges are nil. So you don't have to pay anything at that time. Only thing that they want is they are putting this exit load is because of less operational activities. If you are investing today, don't just play with them by divesting again after within 15 days. Put your money for a long period of time, so there will not be any type of a exit load as well. So we will see some questions related to entry load and exit load also in the mutual funds, where you will have to calculate these types of loads. Okay, they have invested most of their amount in equity, 89.01%, and very less in, we can say, treasury bills. Then minimum investment is 5,000. That if you want to start investing in this, first investment will be 5,000, and after that every month you can invest minimum of 1,000 rupees in this mutual fund. They won't accept 500 or 100 rupees, at least 1,000 rupees is required. Then SIP initial investment is 100 rupees. Okay, so that is a one-time investment that I was talking about. But if you go through a SIP, systematic investment plan, where you automate that, automatically the amount will be deducted from your bank account and it will be debited or credited in the mutual fund, then the investment amount is only 100 rupees. That is well and good. You can do that. The expense ratio is very high, 2.02%. This is something that to look for while investing, before investing in any kind of a mutual fund, because this is very high. 2% of your value. See, 8,500 crore. 8,508 into 2% is 170 crore rupees. You can just imagine what happens with that amount. So 2% is the expense ratio, 2% of the net assets. Every year 170 crore rupees is taken out by these people. Total expense that includes the professional managers' fees, commissions, rent, electricity, everything is covered in that. Risk, this is very risky investment. That is what the Sher Khan has suggested. Returns, if we talk about the returns of this mutual fund, you can see the 1 month return, 3 month return, 1 year, 3 year and 5 year returns. So in average 5 year it has given a good return. If you go for the systematic investment performance is very good as compared to direct returns, because if you keep investing every month, your 5 year returns is around 18.48% per annum. That's a huge investment. That is actually good. Okay, one more thing. Yeah, that's the basic. So, which type of companies this mutual fund has invested in? You can clearly see that top 10 holding, Infosys Limited, 30.63% of the total amount has gone into Infosys. Tata Consultancy, HCL, Bharti Airtel. See, most of them is in the technology IT companies, and some are in this type of like we can say communication as well, telecommunication. Wipro, Tech Mahindra, Emphasis, Z Entertainment, Mindtree, Cyient. So these are some details about where they have put their money, your money in fact. Now let's come to the registrar detail. This is also very important to know who is managing your fund. So the fund manager is Mr. Vaibhav Dusat. You should know about this fund manager, the background of this fund manager, what is his objective, what is this approach of working. These are some address and basic details given to you. So I just showed you a basic thing that happens in the mutual fund. We are going to calculate a lot of things about it in the coming time. So that's all about the practical approach of the mutual fund, sir. And I'm sure you are much more excited by looking at the returns. Obviously, not that big returns that I am earning right now, but I think it's decent enough because I'm not working anything on that. 13 lakh rupees I have earned in the last 4-5 years. Let's imagine that. And 4 years, I think so. On an average 3 years, right? I forgot. So if I'm earning 13 lakh rupees in last 3 years on an average without working much on that, I don't think so. It's a bad thing, right? So 3 4 lakh rupees is the like we can say basic salary that you get, initial salary that you get, and that much if you are earning passively, then it's well and good. Okay, that's just about the equity. That's just about the mutual fund. Let me take you to the equity also, because in the portfolio management chapter, I forgot to take you through the equity portfolio that I have generated. You can clearly see I have invested a little less amount directly in the equity shares. This is the portfolio of equity shares where I do the research and directly invest in IPOs and everywhere. So 22.94. So you can say 23 lakhs I have invested in the equity shares, 30 lakhs in the mutual fund. So that 23 lakhs has become 32, 33 lakhs. So on and around 10 lakh rupees is the return in the equity share as well. 13 13 lakh something was in the mutual fund, 10 lakh here itself. In both the cases around 43-40% is the absolute return. That is good enough. If we directly go through the portfolio, just a second, do we have an access to that? Let me just look at it. There was one option where they used to show the entire portfolio, but portfolio reports. Okay, so that was all about the equities and mutual funds, sir. I hope you had a great time looking at my portfolio. But that's not just the only mutual fund that I have invested in. That's just the Share Khan platform of my mutual funds. I have invested also through ICICI Bank directly. Not that big amount, but that is also giving me good returns. I have invested in 4 types of mutual funds there. So around 4-5 lakh rupees also is there. So all in all, before starting the chapter, I will tell you one thing. Why I am teaching to you guys is the only reason is that I want to I like to play this game, and I like to read money related books. I like to start something related to business, and the life goes around money. And I'm not that a money freak, you can say, but I love working. I love to play the system game. I love to read the books and then create a portfolio, diversify it. All in all, till now, I have invested in equities, mutual funds, real estate. All the three are going well in terms of return, very good in terms of return. But don't just get motivated or excited by this statement. I have also invested in the cryptos, which has given me a bad returns. Like 90% of my value has gone because of the crypto crash in the recent last year, you can say. So yeah, there are bad parts as well as the good parts. I lost money in the day trading. I used to trade in options, call, put. I lost money in that, but because of the time I did not continue it. So it's not just I lost 3-4 lakh rupees in one of the business that I had started, and I had to shut it down. So yeah, this is all about trying, failing, trying, failing, and trying. So if you start with the 10 things, obviously you will be not going good. You might not go good at all the 10 things, but yeah, around 5 to 6 things will work out, 4 5 things will fail, and that's the part of the life, sir. In the next lecture, we are going to start with the practical questions of mutual funds. Bye bye. Okay, so welcome back in this new lecture. Let's start with the practical questions of mutual fund. We'll just shift directly to page number 274. Couple of questions in the beginning are very easy. In fact, the very first one is a lot easier than we can expect. Let's start with the first question. one of the mutual fund that had a net asset value at the beginning. So understand this one thing. At the beginning means this is NAV 0. If you want to buy the units of this mutual fund, you will be buying it at 16 rupees a unit. Made income and capital gain distribution. Underline this word income and write down dividend, and this is a capital gain distribution. So for every unit this mutual fund has given, just a second, for every unit this mutual fund has given 0.03 and 0.04 as the capital gain and dividend distribution per unit during the month, and then ended the month with a net asset value of 16.08. This will become our NAV 1. Understand that this entire question is given, the data is given for a month, and they have asked us to calculate a monthly and average annual return. Return of the investor. So we will call it as a holding period return. And please understand, the basics will never change in this case. The basics is, if you want to calculate the return, you will keep returns in the numerator and investment in the denominator. So NAVT means at the end of the month, terminal time, what was the NAV, and NAV at the beginning is NAVT minus 1. So whatever the format they have used, we are going to stick to our own format throughout the chapter. So I'm just writing the formula again. See, there are three types of return that you need to understand from the point of view of investor. First one is the capital appreciation, that will be called as NAV 1 minus NAV 0. That is the capital appreciation. Then you are going to add dividend and capital gain. So these are the three returns which the investor will be getting. So NAV 0, that means investment will be in the denominator. The logic is, this is not something which we should learn. The logic is very simple. Returns in the numerator, investment in the denominator. NAV1 is 16.08. See, now I will go with this. This is going to be your capital appreciation. Your 16 rupees of the NAV has become 16.08. Then this is going to be dividend. This is capital gain on 16 rupees. This will be your return for 1 month. Please understand, if the data given in the numerator is for 1 month, the return which is calculated will also be of 1 month. When you multiply it with 12, it will give you 11.25% per annum return. This is a return of the investor. See, this is a mutual fund. This is the investor who has bought the units at 14 rupees, no, 16 rupees in the beginning. And mutual fund has taken his money and invested in different spaces in the market. And whatever the return is, 16.08 was the ending NAV for the month. And mutual fund has given this guy means every unit holders, for every unit 0.04 and 0.03 of the capital gain and dividend. So this much, the difference between these two, dividend and capital gain, will become the return. So this was the easiest question. We will just go on to the next one. We will learn something in this one. The first part is very easy. The second part is the learning part. A mutual fund, let's start from the beginning. A mutual fund having 300 units has shown its NAV of 8.75 and 9.45 at the beginning and at the end respectively. So can I say this as NAV 0 and this one as NAV 1? Okay. Then the mutual fund has given two options to the investors. First, take the dividend of 0.75 per unit and capital gain of 0.60 per unit, or these distributions are to be reinvested at an average rate of 8.65 rupees per unit. So we'll come to the second part later on. Let's first find out the return of the first part. What difference would it make in terms of the returns available and which option is preferable by the investor? So think from the investor's angle. If they invest at 8.75 rupees and by the end of the year, underline this is very important if it is month or a year, because institute plays this game. They give the data for the month and asks for the ask the return for the year. They give the data for the year and ask the return for the month. So that's where you need to be very careful. Okay. So can we calculate the return as we did in the first part? Yes, sir. We can easily calculate the holding period return with this particular formula. NAV 1 minus NAV 0 plus dividend plus capital gain divided by NAV 0. So if we take all the returns which has been distributed by the mutual fund, then our return will be like this. 9 point, see here, 9.45 minus 8.75, this is going to be capital appreciation, dividend and capital gain, right? So the return goes to 23.43%. This is option 1, when the dividend and capital gain are paid. See, this is important. But when the dividend or capital gain are not paid to the investor, it is declared by the mutual fund. So investors are eligible to receive it, but it is not paid to the investors. Investors selected that it should be reinvested back to the mutual fund. See, it will look like this. This is the mutual fund. This is an investor. This is a mutual fund. This is the market. So what happened is, for the dividend and capital gain, mutual fund declared it to the investor, but investor had opted for such an option that this dividend and capital gain should be reinvested back to the mutual fund. So basically speaking, these investors are saying that do not pay us this much of the return. Instead, you treat that dividend and income as our investment and give us additional units. So whatever the dividend and capital gain is given or is to be distributed to the investor, that will be invested back at the rate of 8.65. Now let's find out the return in case of reinvestment. I will show you. This is the first option. So what happened? NAV 0, NAV 1, 8.65, 75 and 94, 9.45. Okay. And the dividend and capital gain 0.75 and 0.60. See, so the capital appreciation, which becomes 0.7, then 0.75 and 0.60. These three are the returns, dividend and capital gain. Total 2.05. Okay, when divided by the initial investment, we got the return, which was 23.43%. This was the first option, but what is going to happen in the second option? Let's say number of units. Now it will play a good role, and this is NAV 0. So N0 is for the number of units. Now 300 units you purchased at 8.75, right? So the total investment that you made was this much, 2625. Now what happened in the meanwhile? Let's say on this date, they declared dividend 0.75. They declared capital gain 0.60, 1.35. And you, instead of receiving that 1.35 on 300 units, it becomes 405. Instead of receiving back, you reinvested it. Instead of receiving, you reinvested back to the company, to the mutual fund. And you said that, don't give me this 405 rupees. Instead, you keep that rupees with you and consider it as my investment in the mutual fund at a rate of 8.65. So what will happen in this case? you will get additional units, that is 46.82. You are going to get additional units. So earlier you had 300 units, now you will get 46.82. So can I say that I will have around I will have around 346.82 units by the end of the year, which will be called as N1. And NAV1 by that time was 9.45. So my cash outflow was here. And at this place, there is no cash inflow, there is no cash outflow. I'm not putting any money from my pocket. Whatever they wanted to give me, I am just asking them to reinvest it back. And now the value of my total investment will be 346.82 units into 9.45. So that's 3277.45. So now the only two figures that matters will be this. Because if you have, this is your outflow for sure. Now if you will sell the units, this will be considered as cash inflow. So this money is going out, this money is coming in. In the meanwhile, there is no cash inflow or outflow in your pocket. So whatever 405 was, that was converted into 46.82 units, and we received this 46.82 units, which is considered here as well. So by the end of the year, 346.82 units were there. So now how will you calculate the return? It's very simple, sir. See, R2625 of investment has become 3277.45. So the holding period return will be 3277.45 minus 2625. Am I right? The difference between these two will be considered as an investment return, and the investment was 2625. So you can calculate. 3277.45 minus 2625 divided by 2625 into 100, 24.86%. See, this return is any time better than 23.44, isn't it? Why the return was less in the first place? Because you had received the dividend and capital gain at a much lower rate, at a lower rate than this NAV1. At a lower rate means you have received it in your pocket. So you lost an opportunity to get more units at a lower rate of 8.65. So by the end of the year, your 100 unit, your 300 units was 300 itself. They didn't grow. It was 300 in the beginning, it was 300 at the end. Even if you multiply it by 300, everything in the 300, in this 8.75 also, 9.45 also, and this return also at that time also the return 23.43% will be same. So in case you receive the dividend and capital gain in your hand, there is no difference in calculating the return of one unit or calculating the return of all the units. But here the return of all the units will be different. So you just have to multiply and do the total. How we are going to make the formula out of it? It's very simple. 3277.45 was nothing but NAV1 multiplied by N1. Do you get that? The closing value minus NAV0 multiplied by N0, the beginning value divided by the beginning value, that is investment, NAV0 multiplied by N0. The only difference is that in the second part you cannot do the calculation of return on the basis of single unit because the base is not same. Right now in the beginning it was 300, at the end it is 346, so that's why the base is not same. Base for this and this is not same, that's why we cannot calculate it on a per unit basis, so we will have to do it on a entire basis. But in this case, in the very first case, the number of units were same throughout, and that's why calculating NAV or calculating return for one unit or calculating it for all the units would have given same result. So this becomes the formula in case of continuous reinvestment, in case of reinvestment of the dividend and capital gain. See, now we will go through the formula book. Let me just see, this is the formula. So we have seen this formula: NAV1 minus NAV0, capital gain plus dividend divided by NAV0. This is a normal formula. When we receive the dividend and capital gain, then we consider it. When we do not receive that, we will not consider it. And in case the dividend and capital gain are reinvested, at that time you will take the closing value, total number of units multiplied by the NAV, and you have to just do one correction here. Instead of instead of plus, it should be minus. So that's a mistake in the formula book. Please do the correction. That should be minus. So take the difference between the opening investment and the closing investment and divide it by the closing investment to get the holding period return. Do you get that? So these are the two formulas that we have learned till now. Let's move on to the next question. Take this as an homework. It is going to be same. You need to practice it. This is reinvested. So third one will be your homework. Now have a look on this question number 4. This is very easy question. Just a small change as compared to the previous question. Have a look. The NAV per unit of XYZ mutual fund. NAV is the market price. In place of share, we call it as a unit. This is a mutual fund. A type of the mutual fund is close-ended. On 1/1/2014 was 28. We will call it as NAV0. The value on 31st December 2014, that means exactly after 1 year, comes to 28.80. That is NAV1. On the same date, unit was trading in the market at a premium of 3%. So that was the calculated net asset value, but the trading value, the value at which the market price, we can say, of the unit was at premium of 3%, though on 1/1/2014 same was trading at a discount at 5%. See, on the same date, one thing that you need to understand, on the same date, which was the date? This was the date. That means at the end of the year it was trading at a premium of 3%, but at the beginning of the year it was at a discount of 5%. So the only thing that you need to do is, in the closing value you need to add 3%, and in the beginning value you need to deduct 5% of the NAV. So what we are going to do, this is NAV0, this is NAV1. You can see that NAV0, we are multiplying it by 95%. That means we are removing the 5% of the discount. So we are just eliminating that 5% of the discount and bringing it at a market price of 26.60. Again, this closing value is trading at a premium of 3%. So we are adding 3% in that and bringing it to the market price. Now these two are very important for us. This is called as the capital appreciation, NAV1 minus NAV0. And now if you want to calculate the return, see, you are required to compute the rate of return to the investor during the year. And apart from that, XYZ distributed a sum of 2.80 as incomes and capital gain. So both dividend and capital gain both are included in 2.80. So the only two things will be capital appreciation and income divided by initial investment. So capital appreciation is nothing but 3.06. Am I right? If you as an investor go and buy the units, you will be buying it at the market price and not exactly at this. In the previous question and in the coming question, when only one figure is given, that is NAV0 or NAV1, we will call it as the market price also. So this is the same price at which the units trades. Otherwise, if specifically something is given, then obviously we are going to consider that something else as the market price. So 3.06, 2.80, and the initial investment will be 26.60. Do you agree with this initial investment of 26.60 in the denominator and not taking 28 in the denominator? Because what will be going out of your pocket is the market price, which is 26.60, right? So that should be taken as an investment. That's it. Rest of the question is very easy. Now, question number 5. The following information is extracted from steady mutual fund scheme. This is an easy question. Asset value at the beginning of the month. Can we call it as NAV 0? Annualized return. So in this question, this can be called as a reverse question, right? In the first 4 question, you calculated return. Now return is given to you. Distributions made in the nature of income 0.5 and 0.32. So can I call it as dividend and capital gain? Okay. And what the question is asking us to calculate? The question is asking us to calculate the month end net asset value, that is NAV 1 of the mutual fund scheme, and provide a brief comment on that. Now the only thing that you need to be very careful about, the question seems very easy, that's not a problem. See, question number 5, I will just show you where the mistakes can happen. How do we calculate the holding period return? It's very simple, sir. NAV 1 minus NAV 0 plus dividend plus capital gain divided by NAV 0. So the holding period return given is 15%, which I will write it as 0.15. Okay. NAV 1 is to be calculated minus 65.78 is NAV 0. Dividend and capital gain is 0.50 and 32 and 65.78. Do you agree with this formula? Yes, sir. Everything is perfect. Still, the answer that you are going to calculate with this formula will be wrong. Why? Because of the only thing that you did not notice in the question is they have given you the annualized return and they are asking you to calculate the month end NAV. So basically they are asking you to calculate the difference between a month only, not the annualized return. So what you have to do is you have to just change one thing. Convert this holding period return into monthly return. If you want to calculate monthly NAV, the return should be monthly. If you take yearly NAV, the return will be yearly. If you take monthly NAV, the return has to be monthly. So the only thing that you need to do is place 12 in the denominator of 15, and then the question that you are going to solve, the answer will be correct. See, do you agree with this? Hence monthly return is 1.25%. You have kept 1.25% on this side, rest in the formula, and you will get the same NAV. So NAV 1 and NAV 0 is equal coincidentally in this question, and the comment is only this: there is no change in NAV. That's the only comment that you are going to do. So the entire 1.25% was contributed by the dividend and capital gain. Am I right? Because there is no change in the NAV. That's why there is no contribution of that in the return as well. Cool. Now we are going to learn something about question number 6. Have a look. So let's have a look on question number 6 now. In this question, you are going to learn something about the front end load and back end load. See, this is nothing but the entry load and the exit load. When you want to buy some units of the mutual fund might charge, not compulsory, that they will charge front end load. And when you want to exit or you want to sell out all the units or some of the units of the mutual fund, then while exiting or while receiving the money, sales money, redemption money, you will be charged with the back end load. So both of them will be your expenses. Okay, so how to calculate and what is the concept? Before solving the question, I think we should first go to the concept and learn about it. So have a look. Now let's say, for example, I want to invest 10,000 rupees in the mutual fund, and while investing 10,000 rupees, I will have to pay the front end load. Okay, so I will call it as a entry load. Let's say 200. that is nothing but 2% of the total investment amount. So what will happen? The net assets that I will be investing is 9,800. Okay, because 200 will be charged and kept by the kept as an administration charges, the entry load basically. And at that time, let's say for example the NAV going on is 10 rupees per unit. So your 10,000 rupees is not divided by 10. 9,800 is then divided by 10 to give you the number of units that you will be receiving. So that comes to around 980. So you will get 980 units for at the rate of 10 rupees, but that will be on 9,800. 200 is already deducted. 200 rupees is already deducted as an entry load. And now when you think from your own angle, your investment was 10,000 rupees. So you don't have to do anything with the 200 or 9,800, right? So what you are going to do, you are going to find out the cost per unit for you. So what you are going to do, you are going to divide that 980 units with 10,000. So 10,000 divided by 980 will give you the cost per unit to you. 10,000 divided by 980, it goes to 10.204, right? So 10.204. Now understand the difference. This is called as NAV and this is called as public offer price. 10.204 is the public offer price. This is what you are paying for every unit. 10 rupees consists of the NAV and 0.204 consists of the front end entry load, you can say, right? So the entry load now comes to 0.204 per unit. If you want to calculate it on per unit basis, it comes like this. So the story goes like this, and from this data you have to calculate, you can calculate the POP if the front end load is given, or and if the POP is given and NAV is given, you can calculate the front end load. So let's create a formula out of this. Can I simply write down POP minus NAV is equal to entry load, right? Front end load we can say. And if I want to convert this front end load into a percentage, right now it is in rupees. 10.204 minus 10 is 0.204. I can write it down like this. 10.204 minus 10 is equal to 0.204. So if I want to convert this into rupees, into percentage, what will be the formula? The formula will be same. The only thing is POP minus NAV divided by POP, and that will be your front end load in percentage. You might be thinking that we will have to charge this percentage on 10 rupees. No sir, you remember one thing, the amount that I was investing was 10,000 rupees, and this front end load was charged on this 10,000 rupees. So automatically 0.204 will also get charged on 10.204. So 10.204 will be the basis. You have to remember that NAV will not be the basis. NAV is the result of POP minus front end load. So basically in the formula we do not calculate front end load, we calculate NAV. So POP minus front end load becomes the NAV, but we have interchanged the formula, so that's why it's looking like this. Okay, now you are okay with this. The numerator will give you the entry load in terms of rupees, denominator will give you the basis on which the entry load is charged. Now if you calculate, the figures will be like this: 10.204 minus 10 divided by 10.204 and 0.204 divided by 10.204 into 100, and that goes to 2%, exactly the thing that you wanted to calculate. Okay, now if we, this is the formula for front end load 1, this is the first formula, and you can change this formula as much as you want to calculate the other things as well. You can create a formula for POP from this, you can create a formula for FEL on this as well. So let's do some research. Can I write down POP divided by POP minus NAV divided by POP is equal to front end load in percentage? Yes sir. So basically front end load in percentage becomes 1 minus NAV divided by POP, and that's front end load in terms of percentage. Okay, that's great. Now we can transfer this one on that side, or we can transfer front end load on this side. It becomes 1 minus front end load in percentage is equal to NAV divided by POP. Am I right? Okay. Now you can transfer the entire left hand side on the right hand side and transfer the POP on the left hand side. The formula, ultimate formula for the POP will be NAV divided by 1 minus front end load in percentage. This becomes your second formula for POP. Am I right? POP is nothing but public offer price is nothing but NAV divided by 1 minus front end load. So if we keep the figures here, it becomes 10 rupees divided by 1 minus 0.02. Am I right? 2% was the front end load. So we have to just make sure that 10 rupees is nothing but the 98%, so that we can get the 100% value, which becomes 10.204. Are you okay with this formula? This is the same formula as it is given in here. POP is equal to NAV divided by 1 minus front end load. Did you get the logic of this public offer price? The formula is totally logical. If you do not want to go with this formula, if you find it is difficult to remember this formula, just make sure you remember this one. POP is POP minus NAV is equal to front end load in terms of rupees, and if you divide it by if you divide it by POP again, then you will get front end load in terms of percentage. That's it. Nothing else is required in this. So this is easier to remember than this one. Okay. Good enough. Let's talk about backend load. Backend load is charged when you sell the units. Okay. So let's say, for example, we want to sell all these units, the 980 units that we have purchased. And at the time of selling, the NAV was, let's say, 10 again. Let's take it 10 itself. So we will be having some loss here. So the total value becomes 9,800. But do you think they will pay you 9,800? No, sir. 980 units, if you sell at the current NAV, which is 10 rupees, then 9,800 becomes the total. They will keep, understand, they will keep the back end load from this amount, and then they will redeem you the rest. So let's say, for example, we deduct 200 rupees, the balance comes to 9,600. So this becomes your net assets, this becomes back end load, and this becomes your redemption value. Redemption value means the value that will be payable to you, that is payable to you. And in this also, please understand, in this concept also, the back end load will be charged on the redemption value. Understand, here the front end load was charged on the investment value, invested value, right? 10,000. It didn't, we didn't charge front end load on net assets. Here as well, we are not going to charge the back end load on the net assets, although we are calculating, we are deducting it from 9,800. But in the formula, in the concept, it is better to represent or present it in terms of the redemption value. So 200 divided by 9,600, 200 divided by 9,600, it comes to 2.083%, or just give me a second. Yeah, let's start from this. So you are selling 980 units at the current NAV of 10, and back end load was deducted at 200 rupees. So the redemption value becomes 9,600. For you, the selling value is not 10 rupees. For you, the selling value is 9,600 that you are receiving in your hand, and the number of units that you are selling. So 9,600 divided by 980 is the price for you. Divided by 980 is the price for you. So if you divide 9,600 by 980, 9.79, I think some difference is coming, so let's take it as 604. Yeah, make let's change this figure by around 4 rupees. Let's make the backend load only 196. So this will come to 9604. Now if you will divide the amount that you have received with the units that you have sold, you will get the redemption value, that is 9.80. This will be called as the redemption value. See, redemption price, we can say this is the total value. Sorry, this will be the total value. We will just call it as a redemption price. So this is the redemption value and this is the redemption price. So for you, the 9.80 is the ultimate redemption price at which you are selling the units, because 196 is deducted as a backend load. So how much? 0.20 is the paisa. 0.20 is the amount that you have paid per unit as a backend charges, which will be calculated on the redemption price, not on the NAV. Redemption price. Here as well we calculated 0.204 which of the entry load on the public offer price, and that's why here also we are going to do the same thing. So this amount comes to 0.20, right? Let's find out the formula now. Let's derive the formula. So in this case, we can say that, just a second. In this case, we can say that, please focus on that, NAV minus backend minus redemption price is equal to backend load. So 10 rupees minus 9.80 will be 0.20, right? So 10 minus 9.80 will be equal to 0.20. And this will be calculated on the redemption price. Please remember this. The front end load was calculated on the public offer price. The back end load will be calculated on the redemption price. So NAV minus redemption price divided by redemption price is equal to back end load in terms of percentage. Am I right? So if we write down, it will look like this: 10 minus 9.80 divided by 9.80. .20 divided by 9.80 into 100, that's 2.04%. So this was 2% on the public offer price. This is 2.04% on the redemption price. Let's focus on the formula now. Now this formula can also be written as NAV divided by redemption price minus redemption price divided by redemption price is equal to back end load in percentage. Now NAV minus redemption price divided by redemption price minus 1 is equal to back end load in percentage. So we can just change few things here. We can transfer the 1 on that side, so it will become plus 1. So NAV divided by redemption price is equal to back end load, have a look, plus 1. Now this is where things will change. It was 1 minus front end load. This is back end load plus 1 in terms of percentage. And if you transfer the denominator on that side, it will look like NAV divided by backend load in terms of percentage plus 1 is equal to redemption price, and this becomes your formula for redemption price. And for a backend load, this is the formula: NAV minus redemption price divided by redemption price. For redemption price, this is going to be the formula. So all these formulas are derived from the simple concept of this. So you need to remember this only. See, You write back end load plus 1 or 1 plus back end load, it is one and the same thing. So you need to remember always that NAV divided by 1 minus front end load will be POP, but 1 plus back end load will be redemption price. That's it. This is the simplest thing that you have to do. This is the purchasing NAV starting, this is the selling NAV. You need to remember that always. So this is how we calculate the back end load and the front end load. Okay, now the question has asked us to calculate the front end and back end load. Please have a look. Front end load is nothing but POP minus NAV divided by NAV, and back end load is nothing but NAV minus redemption price divided by redemption price. See, front end load is nothing but POP minus NAV. Make sure it is not NAV in the denominator. So divided by POP and NAV minus redemption price divided by redemption price. The only way to remember the formula is you should not keep NAV in the denominator. That's it. So let's find out if we have everything in place. This is the POP, this is the redemption price, and this is the NAV. So all the figures that I have taken in this example that I explained you, 10.204, 10 and 9.80 are the same as given here. So the answers will also be same for the front end load and the back end load, which is nothing but 2% and 2.04%. Have a look. So it is 2% and 2.04%. Are you okay with this? Then when you go for alternative answer, the alternative answer exactly reverses the answer. It was 2% and 2.04% if you go with the POP and redemption price. But if you take the basis as 10 in both the cases, then the answer exactly reverses. But I will suggest you not to follow this, because the logical answer is this much only. Why logical, sir? Why 10 rupees is not logical? I will tell you. What happens is the amount that you are to receive, or the amount that you are investing. So everything, front end load and the back end load, is looked from the angle of the investor, how much he is paying and how much he is receiving. So it becomes easy in the market to apply the percentage. Now this percentage of 2.04 is applied on 10 rupees. This percentage of 2.04 is applied on 10 rupees. So if I say that you have to pay a back end front end load of 2.04%, it might seem higher to you, because this is not what you are paying. 10 rupees is not what you will be paying. If you say 2% on POP, then it becomes easy for investor to understand, because this is what he is paying now. If you say 2.04, see, if you go here and if you say 2.04%, he will be easily able to understand that, okay, whatever I have received, 2.04% of that I have paid as a back end load. So if you look from the investor's angle, these are the correct percentages. But from the institute's angle, both are same. So from the marks purpose, what you have to do in the exam is solve the question from both the ends if you want to. Otherwise, the first part was easier one. If some more questions are to be asked in the exam, they will surely going to ask on these type of formula that I have explained. I understand that this is very easy to remember. But don't fall into the trap. You might lose the marks. There is something which is given in the syllabus, so I think you should study that. Cool enough. Question number 6 is over. Now we are going to focus on question number 7. Have a look. During the year 2017, an investor invested in a mutual fund. Okay, in 2017 he did invest. The capital gain and the dividend for the year was 3 rupees per unit. Both the income are included in this, which were reinvested. Okay, so this is a case of a reinvestment. At the year end, just give me a second, I just need to put a space in between year and end. At the year end NAV of 23.75. So when the dividend was declared, dividend and capital gain was declared at 3 rupees per unit, the investor reinvested the entire 3 rupees into the number of units. So I think he had around 26,750 units. So 26,750 into 3 rupees, entire amount was reinvested back at 23.75. The investor had a total of this much of the units at the end of the year. Okay, sorry. So these 26,750 are the number of units calculated after receiving the additional units on reinvestment of dividend and capital gain. Do you get it? See, N was the number of unit at the beginning. Then what happened is you received N multiplied by 3 as a capital gain and dividend, and then this entire amount was reinvested at 23.75. And then what happened, the total of the additional number and the existing numbers was 26750. Now you can easily calculate with this formula how many units you were holding at the beginning. Good. The NAV had appreciated by 18.75%. Appreciated, that means NAV 1 minus NAV 0 divided by NAV 0 is nothing but 18.75%. That's what the question wants to say, that it had appreciated by 18.75% during the year, and there was an entry load of 0.05 at the time when the investment was made. Okay, so this much we have to adjust in the NAV. The investor lost his records and wants to find out the amount of investment made and the entry load in the mutual fund. Before looking at the answer, you need to clearly understand how are you going to calculate the amount of investment made. Sir, public offer price multiplied by the number of units at the beginning. This is what the investment that you have made. The investor will obviously pay 10.204. If you look at the previous question, he is going to pay 10.204 for 1 unit. With this formula, we are going to calculate the number of units. Then with this formula, we are going to calculate the beginning NAV. Beginning and yes, we can easily calculate it. And by adding 0.05, in the beginning NAV, we will calculate the POP. So when we multiply POP with N0, we can easily get the amount of investment that we have made. Okay, let's go ahead. This is the year end NAV already given to us. Have a look. This is an interesting question, and I like such questions where they asks us not to just put the values in the formula, but to apply the brains and do the reverse calculation. And reverse calculation is possible only when you know the concept. Okay, let's come to this question number 7. Have a look. So first of all, the main answer that we need will be calculated with this amount of investment. Have a clear idea that public offer price multiplied by the number of units at the beginning will give you the exact detail that you need. Now we want to calculate both of these. So first of all, let's calculate the number of units. Now tell me one thing. The original number of units were N0. Okay. Plus what happened is that on those number of units, you received 3 rupees per unit as dividend and capital gain, and entire amount was reinvested back at the year end NAV. That was NAV1 at 23.75, right? And the total after after getting the additional units, the old units at the beginning units was N0, and the additional unit is this much, then the total units that you received or you had at the end of the year was 26,750. Now with the help of this particular equation, we can calculate the number of units at the beginning. So let's do that. So let's do one thing. This is going to be 3N0 divided by 23.75 is equal to 26,750 minus N0. This N0 from the left hand side will go to the right hand side. Then this denominator of 23.75 will get multiplied on the right hand side. 26,750 into 23.75, 635312.5 minus 23.75 N0. Okay. Now this 23.75 N0 will come on this side. It will look like this. 635312.50, and with the help of this we can get the number of units. That will be 23750. These are the total number of units. These were the total number of units at the beginning. Now every time you do such type of calculation, if you get an opportunity to cross check, please do that, so that any calculation mistake will get eliminated. So this 23.23750, put this in this equation, entire equation, and the answer should be 26750. Let me do that. And yeah, it is coming to 26750. So this answer is absolutely perfect. One calculation is over out of the two, right? Now we are going to calculate the public offer price. We know that the public offer price is nothing but the NAV plus the load. We can say front end load. Or according to our formula, it was nothing but public offer price minus NAV 0, because it will be applicable on that. Na? Front end load we are purchasing. Right. So we do not know NAV 0. We do not know POP as well, but we know one thing, which is the entry load, which was 0.05. That's great. The entry load was 0.05. Now if we anyhow can calculate NAV 0, then it will be very easy for us to calculate the POP, right? Public offer price. That's what is needed. Now again, let's keep the space for this calculation and come to the NAV 0 calculation. Now NAV1 minus NAV0 divided by NAV0 is equal to how much percentage? And if we multiply it by 100, we can write down 18.75% was the increment, in the net asset value. We can write down this formula as NAV1 divided by NAV0 minus 1. Like, I will just make sure you understand each and everything. So I can split this NAV0 in both of them, and I can write it like this, is equal to 0.1875. This 100 when goes to this side will become will convert this entire figure in the decimal. Now NAV1 divided by NAV0 minus 1 is equal to 0.1875. So can I write down NAV1 divided by NAV0 is equal to 1.1875. Are you okay with this answer? I have derived it from this itself, right? Now we know the NAV1, which is 23.75 divided by 1.1875 is equal to NAV0. Am I right? If we transfer this right hand side to the left hand side and the denominator of this left hand side on this, it will look like this. So with the help of this, we will get the NAV0. That goes to 20 rupees. See, now all the figures can be connected with each other. So we will keep this NAV0 here. POP minus 20 is equal to 0.05. So can I say POP is nothing but 20.05? This 20 will go on that side, and if I keep that here, it will be 20.05 multiplied by 23750. No, it's 20, right? Then so it will look like 476187.5. Let me do the calculation once again. Yeah, 476187.5. This was the amount that I invested. So this is how everything is linked. Obviously my answer is little lengthier than what has been written by the institute here. Institute has summed up everything in this much of the step, but the logic of all this has been step by step explained here. See, if you look at this NAV calculation, they have directly written it like this, na? 23.75 divided by 118.75. I did the same thing. See, 23.75 divided by 118.75 into 100. So this is the same thing. But starting directly from here and starting from here will make a difference. This will explain you the entire step. So as a teacher, this is my job. Okay, I will tell you. As a teacher, I have to write down this much. This is the teacher's job. And as a student, if you have learned about this process, then in exam you can directly start from this. Obviously you should write the formula. So as a student you should do this much only to save the time. NAV1 divided by NAV0. So there are two options with you. If you are very comfortable and 100% confident about the formula, then start from here in the exam and save time. And if you're not comfortable, then please start from here. It's okay to spend some time, like invest 1 or 2 minutes extra than the other people, but you will ensure that you are getting the marks. And in case you are not confident and you are starting from this phase, and by chance this equation gets we can say, by chance if you make some mistake on that equation or the formula, then you will lose all the marks just for saving a couple of minutes. So if you're confident, start from this point. If you're not confident, start from that point. Okay, let's go ahead and discuss about question number 6. I think sorry, question number 8, question number 9 are one and the same thing. So we will need to learn a new concept also in this case in question number 8. So I'll just take a break of around 5 minutes and I will be back with question number 8. See you. So now let's have a look after this break on question number 8. This is going to be a new concept where we are going to find out how much a mutual fund should earn so that investor gets his desired earning. Now what is the meaning of all that thing? Let's first read this question. According to the question, we are going to take the example and derive the formula. So at the same time we will be solving the question and deriving the formula also. Mr. A can earn a return of 16% by investing in equity share on his own. So let's first draw this. This is going to be question number 8. So let's take this as Mr. A. And he can invest directly in the company. So this will be his direct investment. And he can earn 16% out of that. But now if he is not putting money directly into the equity and if he is going through the mutual fund, let's say the mutual fund is here. And if he is going through mutual fund, that means he is giving money directly to the mutual fund. And then this mutual fund is investing this money into the equity market. Now what happens if you directly go to the equity market and invest by yourself? You will need two things. The first thing is the time. You will have to invest your time. And the second thing that you need is the knowledge. Okay, but if you go through mutual fund, obviously you will not need that much of the time and that much of the knowledge. Obviously a little time and a little knowledge will be sufficient enough to go through mutual fund. So what is happening is the professionals are sitting in the mutual fund units so that they can manage your money better than you. That's why they are going to invest in the same. So they are investing in the same platform, but the timing and the amount is different than what you would have done. So if you are putting your money directly to the mutual fund and not in the equity, how much minimum return that you would expect a mutual fund to pay? Mutual fund should pay you at least 16% of the return will be expected by you, because that much is something that you can earn directly by investing in the equity. So if you are putting money in the mutual fund, you will expect that the mutual fund should give me a return of at least 16%. Okay, let me just remove it for the time being and let's just go through this process. Let's say that if an investor is putting money in the mutual fund, and what is happening is he is giving around 100 rupees to the mutual fund. Out of that 100 rupees, let's say 5 rupees 550 paisa is an initial expenses. This will be termed as an initial expenses. So these are the initial expenses of the mutual fund. That means some brokerage charges, the issue charges, and so on. Now the amount which is left with the mutual fund is only 94.5 rupees. Am I right? This much is only left with the mutual fund, and this much will be invested by the mutual fund in the market. So the investment of the mutual fund is 94.50 rupees. Now what happens is there will be certain type of return that mutual fund will earn. Okay, let's say the red line indicates the returns, right? This is what the mutual fund will earn. Now tell me one thing, how much minimum the mutual fund should earn so that it can give the investor his desired return? It's very simple, sir. This 100 rupees could have been invested directly in the equity by the investor, and at that time this investor would have earned 16% on this 100 rupees. So the direct investment in equity would have resulted in a return of 16 rupees for the investor. So at least 16 rupees should be earned by the mutual fund so that that amount can be transferred to the investor. But let me tell you one thing, the amount that is needed to be transferred or that is needed to be earned for our investor, he is our investor, is 16 rupees, right? Now let me tell you one thing, the people who are sitting here are professionals. They will have to be paid for that knowledge and the time that they are spending here. The place at which they are sitting and doing the operations is a rented place, or maybe say we can say a bought out place. So we have to bear that expense also. Electricity, rent, salaries, operations, table, chair, fixed asset, depreciation, all the other expenses, just like a normal business, will have to be borne by the mutual fund if they are operating or if they are managing the money of these investors. So obviously there will be some other expenses which will be called as recurring expenses. Every year the salaries will be there, electricity will be there, food will be there, rent will be there. So some recurring expenses will also be there. And see, investor doesn't have to do anything with those recurring expenses, right? He needs 16% return, 16 rupees return at least, because he could have earned the same thing without these recurring expenses by investing directly in the equity. So it's the responsibility of the mutual fund, it's the responsibility of the mutual fund that these recurring expenses should also be earned directly from the equity. So what is going to happen, let's say for example these recurring expenses are around 1.5%. Let's write down. So these recurring expenses, let's say, are 1.5%. How much is the 1.5%? See, 1.5% will be applicable on the amount of investment that the mutual fund is managing, not 100 rupees, because 100 rupees is not something which is collected by the mutual fund. Mutual fund only collected 94.50, so the entire year mutual fund is managing the assets of 94.50 only. So recurring expenses will be calculated on that. So 94.50 into 1.5% comes to 1 rupees 42 paisa. That will be 1 rupees 42 paisa. That is called as recurring expenses. Okay. So this will also have to be managed or earned by the mutual fund. So please understand the logic. The mutual fund, when investing 94.50 rupees directly in the market, mutual fund will have to cover up two types of return from the market. One for the recurring expenses, one for the return to the investor. So let's take this as the return. Let's say for example the equity is giving this much of the return, 16 and 1.42, that is 17.42. So this is the minimum return that the mutual fund should earn from the equity market, because what is going to happen once you earn 17.42, what will happen is this 1.42 will be deducted at this place. 1.42 will be deducted at this instance. Out of 17.42, the mutual fund will be left with the 16 rupees, and that those 16 rupees can be distributed to the investor like this. See. So this is how they both of the earnings will go. So now investor is happy because mutual fund has earned 16, has given 16 rupees on his investment. From the investor's angle, investor doesn't have to do anything with the initial expenses or any other type of expenses. For the investor, he is putting 100 rupees in the mutual fund, he is getting back 16 rupees. He is happy that he is earning at least 16%. For the mutual fund, these two should be the earning. Mutual fund will also be happy that we are able to cover all our salaries and everything in 1.42 rupees. Okay, 1.42 crore or whatever. So 1.42. So the total return or the minimum return that the mutual fund should earn from the market is 17.42 rupees. Now everything should be converted into the percentage. What is happening in this question is, in this question they have given you the return that is expected by the investor, which is 16%, and the question is asking you how much mutual fund should earn so that it can give a desired return to the investor. Now we know the amount, that is 17.42, but the question is asking you to find out that return the mutual fund should earn in percentage, not in rupees. So let's find out the formula for that. Now we know two things. The mutual funds earning from the market should include two things: investors earning plus recurring expenses. So investors earning is rupees 16 and the recurring expenses is rupees 1.42. In this way, 17.42 should be earned by the mutual fund. But we do not want this in rupees. We need it in percentage. So let's convert this 16 into rupees and the 1.42 also in the rupees. But let me tell you one thing, this 16 and 1.42, that is 17.42 rupees, will be earned by mutual fund on 94.50. Am I right? So can I write down, if I want to convert it into percentage, 16 divided by 94.50 multiplied by 100 plus 1.42 divided by 94.50 multiplied by 100. Right? One more thing. Can I write it down like this? 16 into 100 divided by 100 minus 5.5. 100 minus 5.5 is also 94.5, right? Because I want to give the adjustment of initial expenses in the formula, that's why I have converted this 94.5 like this, 100 minus 5.5. Also, this entire 1.42 divided by 94.50 into 100 gives us a percentage of 1.50. So the second part is already converted into percentage. Now focus on the first part. Now what I am going to do, I am going to convert all these figures in percentage by dividing the numerator by 100 and dividing the denominator by 100. So have a look. In the numerator it is multiplication, right? In the it is multiplication. So 16 multiplied by 100 divided by 100. Okay? And in the denominator, can I write it like this? 100 divided by 100 minus 5.5 divided by 100. Because if there is a plus or minus, we can take the denominator, we can split the denominator in both the figures. We cannot do that when it is multiplication and division. That's the maths rule. Okay, plus 1.5. Now see what I am going to do. This 16 will get converted into percentage. 100 by 100 is 1 only. So this 16 will get converted into percentage into 1 divided by 100 by 100 is 1. Then again this is what 100 by 100, 1 minus 5.5 divided by 100 is 0.055 plus 1.50%. See, now we can convert this entire thing in a formula. 16 was nothing but investors earning multiplied by 1 divided by 1 minus initial expenses. Am I right? 5.5% was nothing but the initial expenses plus recurring expenses. And understand one thing, all these are in percentage. Investors earning is also in percentage, initial expenses is also in percentage, recurring expense was also in percentage. All these, and with the help of this we can calculate the amount or the percentage that mutual fund is required to earn. This is going to be the mutual funds earning. This much of the part will make sure that the mutual fund is earning what the investor needs. Okay, this much of the part will ensure that the mutual fund is earning what it needs for itself, like themselves, right? So this is going to be the formula. Will you remember this? Mutual fund earning is nothing but investors earning into 1 divided by 1 minus initial expenses plus recurring expenses. Now see, this recurring expenses is a direct calculation on 94.5 rupees. That's why there is no complications in that. But this investor earning was on 100, should be on 100, but we have only 94.5 rupees. So that's why 16 divided by, we are making it sure that the initial expenses are taken into account. This 16 rupees has to be earned by mutual fund on 94.5. So 16 divided by 94.5 is done, so that the percentage will come, which will be the result of, which will be the requirement by the mutual fund as an earning on 94.5. So if we keep the formula, keep the values in the formula again, it will be 16 into 1 divided by 1 minus 0.055 plus 1.5%. Are you getting it? So this is how we have to solve it. So how much the answer will be? I'm just going to solve the 16 divided by 0.945 plus 1.5. So it goes to 18.43%. See, this is going to be the earnings of the mutual fund. What is going to happen? Mutual fund will earn 18.43% on 94.5. That will be 17.42. Out of that, 1.42 will be the recurring expenses and 16 will be the investors earning. So these two are covered up. This 1.42 is calculated on 94.50, 1.5%, and the 16 is calculated on 100 as 16% for the investors. So this way we are making sure that the investors are getting their desired return and mutual fund is also covering their desired expenses. So summarizing it, investor wanted 16% on 100 rupees that he could have directly earned by investing in the equity. But if he is earning in the mutual fund, he is expecting 16 rupees at least. After investing 100, he is expecting 16 rupees from the mutual fund. Okay. So mutual fund's responsibility is to earn at least this much from directly by investing in the market. But apart from this 16 rupees of the investor, mutual fund wants to cover the expenses of them, of the company also. That comes to 1.42. That 1.42 is nothing but the 1.5% of the total assets that the mutual fund is managing. So in total, mutual fund is responsible for earning from this investment the total of 16 and 1.42, that is 17.42. So we started with the formula that we have to earn, that the mutual fund wants to earn 16 and 1.42 both on the investment of 94.5. So 16 divided by 94.5, 1.42 divided by 94.5, and we converted this 94.5, the first 94.5 as 100 minus 5.5, so that we can take into account the initial expenses, and this way we have created this formula. Mutual fund earning will be equal to, see, mutual funds earning will be equal to investors earning minus into 1 minus initial expenses, 1 divided by 1 minus initial expenses plus recurring expenses. Are you okay with this? Let's solve this question. So the first question I think is over because we have already taken this example and 18.43% is your answer. Let's come to the second part. Mr. X earns 10% on his investment in equity share. So in the previous example, it was 16%. In this, it is 10%. He is considering a recently floated scheme of a mutual fund where the initial expenses are 6% and the annual recurring expenses are expected to be 2%. How much the mutual fund scheme should earn to provide a return of 10% to Mr. X? It's very simple. See, R2 means the mutual funds earning. Am I right? So 1 divided by 1 minus initial expenses, R1 is the investor's earning. So 0.106, you can put the values and you can get the answer in this question directly. Question number 10 is also like that. Let's have a look on this first. Okay, coming back to question number 9. It was very simple. If we do it according to our way, let me just go through it. We wanted to find out mutual fund earning and investor could earn 10% directly in the market. So if we invest in the mutual fund, the initial expenses are 6%. So the company or the mutual fund will be left with 94% of the total fund because 6% will be gone in the initial expenses. So so the mutual fund has to earn 10 rupees on 94. So that is what we are calculating. Plus recurring expenses 94 into 2%. That's 2. We have to write it in percent itself. So 10 divided by 0.94 plus 2. So that's 12.64%. This the mutual fund will be earning on 94. So that is going to be 11.88. Have a look. Out of this, 2% on 94, that is 1.88, will be kept as a recurring expense and 10 rupees will be given to the investor. So both the investors and the recurring expenses are satisfied. Question number 10. Mr. Alex, a practicing chartered accountant, can earn a return of 15% by investing in equity share on his own. So that's the investor's earning. He is considering a recently announced equity-based mutual fund scheme in which initial expenses are 6%, recurring expenses are 2%. It's just like the previous question. There are some changes obviously. Instead of 10%, here they have given us 15%. Now, how much should the mutual fund earn to provide Mr. Alex a return of 15% per annum? This is very easy. You just put that formula and you will get the answer for the first part. The challenging one will be the second, or the learning part will be the second. So let's just complete the first part and it's very easy. Mutual fund earning is equal to 15 that the investor can earn, but the mutual fund has to earn that 15 rupees on 94 only because initial expenses are 6. So I will write down 1 minus 0.06. Am I right? Plus 2. So 15 divided by 0.94 plus 2. That's 17.96%. Am I right? Let's just check the answer. Cool. So this is very easy. Now let's come to the second part. Second part is very important and very much practical when we compare this with the real life. Now what is happening is Mr. Alex is having two sources of income. First is the professional receipt, that is 40 lakhs, and the second is the receipts from the market where he is managing a portfolio of 50 lakhs. Now what is happening, if he is managing a portfolio of 50 lakhs, he might be earning 15% on that. Right? So there are two things that he is doing right now. Question number 10. Current situation. Professional and portfolio, or we can say investment in earning. So he's earning 40 lakhs right now. Okay. And he's managing a portfolio of 50 lakhs where he is earning 15% by his own. So the total earning is 7.5. 40 from the professional income, 7.5 is the investment income. The total income right now is 47.5 lakhs. Okay. But if we go to the mutual fund, in case he choose to invest through the mutual fund, divert funds to mutual fund, what will happen? There will be two things. He will lose some proportion in terms of investment income. He will divert the entire funds to the mutual fund. So 50 lakhs is transferred to the mutual fund. Now mutual fund is working for on his behalf and he is earning only 6.5 lakhs a year. So practically speaking, he has lost 2% of his income. That's a bad news. 2%. That's a loss of 2%. That goes to 1 lakh rupees around. Okay. But we can say that this 2% is nothing but the charges that we are paying for the professionals who are sitting here to manage the funds. That's all okay. So there is a loss of 1 lakh rupees. But what is happening because of this diversion is that we are able to save our time of 10% and invest that time in the professional practice, the practice that we are doing, and we can increase this income by the same proportion. So the question is saying that we can earn 40 into 1.1, 10% extra. We can earn 10% extra. That means the earning here will be 44. So isn't it a good deal? Yes, sir. There is a gain of 10% which comes to 4 lakh rupees. So the total is 50.50. So if you calculate it through horizontal line, 4 minus 1 will be 3 lakhs, the benefit. Net gain. If you go through this way, 50.50 minus 47.50, the net gain is 3 lakh. If you go through this way, the net gain is 3 lakh rupees. So yes, it is advisable to Mr. Alex that he shifts his portfolio to the mutual fund. Basically there are two things which is happening. He is able to save the time. The time saved is gaining him around 4 lakh rupees, and this is where 1 lakh rupees he is losing. We can say 10% of time which he has saved is costing him 1 lakh rupees in the portfolio because he is not paying attention to the portfolio, but it is gaining around, but he is profiting from it around by 4 lakh rupees. Now I'm little bit not satisfied with the answer. I will tell you why. If you take it on face, then this is the correct answer given by the institute also. This is the correct answer. You can see 3 lakh rupees is the net benefit. But I will tell you one thing. Can I say, this is just my analysis apart from the answer. Can I say that earlier he was spending 90% of the time in professional and like practice and 10% of the time in managing the portfolio, right? And the question clearly says that if he spends this time on professional, his professional income will go up in the same proportion. What kind of a proportion? If we call it as the same proportion, then 40 lakhs is what we have earned by spending 90% of the time. So if you divide 40 by 90%, you will get 44.44. So if you invest that 10% time in the professional income as also, then your net income should be 44.44, not 44. So instead of like doing this 40 multiplied by 10%, 4 lakhs, we should be doing like this: 40 divided by 90%. Then we can calculate how much should be the earning on 100% timing, that is 4.44. So according to me, it should be 44.44 if we go deeply by the logic. But don't do it in exam because institute has not done it that way. Think about this particular same proportion thing. Do it just what the institute has done for now. Have you understood this question? Let's move on to the next one now. Question number 11. Now from question number 11, I think we are going to change the concept, and it's very easy. We will be calculating the return for the investor, and that is easy because we have seen couple of questions in the beginning like that itself. So question number 11, let's have a look on this.